If you look at the bullion banks, Goldman Sachs see gold at 5,400 at the end of the year. Most of them see it around 6 and even higher than 6,000. And in 2 years' time, we could be even at 8, 10,000. I wouldn't be surprised.
BOA is saying that silver could potentially trade anywhere between $135 and even $300 per ounce by the end of 2026. Their thesis there is based on the possibility of a massive compression in the gold to silver ratio combined with a tightening physical market and gold potentially moving towards 5,000.
Silver would go up above 100, and China's really, they're the ones leading the BRICS. They've been buying a lot of silver as well. I think in March they bought a record amount of silver. In India, even though they're asking people to stop buying gold and silver, I follow them too. And for all the major countries, it's making record highs. They are kind of inflating. They're talking about higher rates, but at the same time, they're pumping the liquidity into the system.
Mario, you recently said on your YouTube channel that silver can reach $100 per ounce by July. That's very soon. We're at what did we say, $76 right now. Break that down for us. How does silver reach $100 by July?
Yeah, so here's the chart, and the reason why I see it going probably to near 100 by July is that we saw a low here on March 23rd, around 60. And ever since then, we've seen higher highs and higher lows. And the recent low here also hit this trend line that we had broken out of. It retested it and it's held. So if we make a new high in the next few weeks, I mean, and we go through 90, it's a very like, it's not very far away from 100, and that's why I said I think we could go to 100. It's just it looks like we're now back on the trend is higher because we're making higher highs and higher lows. Of course, this is nothing is ever like in technical analysis can change, but it looks pretty good in my opinion.
And what do you think could be the fundamental or macro narrative that gets that to align with the technicals?
Yeah, I guess it would be like the some kind of like settlement in this Middle Eastern conflict.
Mm-hmm.
Yeah, that would help silver because silver and gold have been like every time things get worse geopolitically with that war, uh, oil goes up and gold and silver get yeah, they get hit hard.
Silver doesn't need panic to explode higher, but many investors still wait for crisis headlines before reacting. Mario Innecco notes the March 23 low near 60, and repeated higher highs matter, because trend confirmation often starts before mainstream conviction. The deeper issue is whether geopolitical easing could redirect capital back into industrial metals, while retail still treats silver like a passive hedge. If this setup holds, underexposed savers could miss the sharpest repricing phase. Next, Mario Innecco reveals why conflict resolution may ironically become more bullish than panic itself.
So yeah, I would think it would be pointing to some kind of resolution of the conflict.
Before we get more into price forecasts, I believe that you said that you have some sources that are indicating that central banks and sovereigns in the Middle East are buying silver as a monetary asset. Correct me if I'm wrong, and if not, please elaborate on that.
Yeah, I mean, I've been hearing that since last year, like like the second half of the year, that they've been buying not just silver but gold and physical. And if you think about it, the higher the price of silver goes, and I mean, we are at unprecedented prices going back. If you go back 45 years, if someone had told you like a year ago that silver would go up above 100 and would be at 75, people would have questioned that because that 50 level had been such a big barrier. But the higher the price goes, the more interesting it becomes as a reserve asset because it's more interesting to hold gold in a central bank vault if it's at 150 or $200 than it is at $20. So it's less bulky. And I think the other reason they're buying physical silver is because there's a there's a realization that countries need to safeguard uh, like real things, real raw materials uh, for developing new technologies, AI, and also for electrification, especially with what's going on in the Persian Gulf or with the Strait of Hormuz. Uh, I think like China has proven that they've rebalanced their energy like infrastructure quite well.
When sovereign buyers quietly accumulate hard assets, retail usually hears about it after price discovery is already gone. According to Mario Innecco, rising silver prices may actually increase reserve appeal because value density changes how central banks view storage and strategic holdings. That matters because this is not just a commodity debate, it hints at whether physical metals are being treated as infrastructure insurance beneath public monetary rhetoric. Savers focused only on CPI headlines could miss institutional repositioning. Next, Mario Innecco exposes why strategic resource buying may say more than official reserve policy.
They're doing a lot of let's say they're moving towards EV a lot in China, and they actually use thermal coal to power their electric power for the EVs. Of course, in the West, we're not doing that because we, especially here in the UK, we're into this climate change thing that we can't use coal.
Well, that's a whole other conversation, amongst other things that are happening in the UK. Some other well, some policies that I certainly don't agree with. But again, that's a whole other conversation. But let's bring it back to silver. I get the idea of resource nationalism, and I get the idea of countries doing that and protecting those kind of assets. But I believe you said that it was being viewed as a monetary asset and hoarded on that level, according to the reports that you have. Can you expand on that a little bit? And if so, if that trend continues, is that one of the narratives that becomes so bullish for silver?
I think so, yeah. And it's both monetary and also for resource
Industrial.
nationalism. So, yeah. And I think also it's going to be a big part of the monetary system, if you want to call it, for China's really, they're the ones leading the BRICS. And they've been buying a lot of silver as well. I think in March they bought a record amount of silver. And yeah, and I've in India, even though they they're asking people to stop buying gold and silver, they did make silver from I think April 1st. You can use it as collateral for
Yeah.
loans, so it's becoming much more important. And I think it could be the same thing for these countries and China.
Markets call silver industrial, yet policy moves increasingly treat it like strategic collateral. What Mario Innecco is highlighting is a deeper shift where silver may sit between monetary trust and resource nationalism, especially if governments protect supply chains while public narratives stay focused on inflation and rates. That contradiction matters because collateral acceptance and state-level accumulation can reshape perceived scarcity long before retail notices. Wealth protection often starts when asset identity changes. Next, Mario Innecco unravels why silver's monetary role may contradict how institutions still publicly classify it.
I mean, you look back and historically, I think China, the word for bank is silver. The word for money in many languages is silver. So why not go
Right.
back to it?
And it does have that unique dual identity of being an industrial as well as a monetary metal, and the industrial uses for silver continue to increase from electrification, weaponry, AI, data centers, again, topics we've expanded and discussed at large on this channel and on this show. Let's get back to some of these price forecasts as we wrap up here, because it's fascinating to see some very dramatically bullish forecasts coming out of Wall Street when it comes to silver. Bank of America recently issued one of the most aggressive institutional silver calls that we've seen in decades. BOA is saying that silver could potentially trade anywhere between $135 and even $300 per ounce by the end of 2026 under what they say is an extreme upside scenario. And their thesis there is based on the possibility of a massive compression in the gold to silver ratio combined with a tightening physical market and gold potentially moving towards 5,000. We've got Citigroup, Mario, also highly bullish. They're projecting silver could reach between $110 and $150 per ounce later this year. They're citing several physical shortages in key global trading hubs. Goldman Sachs says silver could average between roughly $85 and $100 per ounce, largely driven by structural industrial demand tied to electrification, solar, AI infrastructure, and the broader energy transition. JP Morgan sees silver remaining historically near the low to mid $80 range through the year end. Those are the bullish voices. What do you make of some of those forecasts?
Wall Street usually upgrades bullish targets after positioning is already underway. Not before. Mario Innecco's argument suggests the real issue is not headline price targets, but whether tightening physical supply and industrial demand are forcing institutions to revise assumptions faster than retail can react. When banks discuss triple-digit silver while still defending cautious narratives elsewhere, that timing deserves scrutiny. Investors ignoring these shifts may underestimate repricing risk across hard assets. Next, Mario Innecco reveals what institutional forecasts quietly admit about scarcity versus public market confidence.
You said you see silver hitting 100 by July. If that happens, where do you see silver by the end of 2026?
Yeah, I mean, I agree with Bank of America. I think if we break 121, which was the high at the end of January, it will go very quickly up to probably like 200. So maybe not 300 like Bank of America sees it, but why not 200? And I think in the last few months since the top in gold and silver, the euphoria and the froth has been taken out of the market. And yeah, people, there's a wall of worry right now. I think there's a lot of worry. A lot of people, yeah, concerned that it's going to go lower. And usually that's a good thing. That's a reverse indicator for you know, the sentiment being low. And I saw the other day as well, Michelle, that I think Bank of America bought a big chunk of a silver mine as well.
Mm-hmm.
I don't know if you saw that. So
I did see that. So to be clear, you're saying silver $100 by July and $200 by the end of 2026. That's your outlook for silver right now.
Yeah, I mean, if we break 120, it could very easily go there. I think it's possible. Yeah.
How does that fit into the sort of stagflationary issues that we discussed at the top of the show? Slowing economic growth, obviously rising interest rates could, if that happens, cutting rates could play into the silver idea. But
when fear stays high while price structure strengthens, that's usually where late retail exits and smart money waits. This is where Mario Innecco's thesis shifts from price speculation to sentiment compression, because a breakout above prior highs would matter less than what weak hands already surrendered. The bigger contradiction is banks discussing upside while capital still treats silver as optional insurance. For long-term savers, missing re-entry can hurt more than volatility itself. Next, Mario Innecco exposes why institutional confidence often rises when public sentiment looks weakest.
How does this rising silver price play into that bigger macroeconomic picture and the concerns that you had about stagflation?
Well,
given the industrial aspect to silver.
Yeah. I mean, back in the 70s, you had stagflation, and gold and silver did well. So that's why I see it doing well. And I think the central banks and governments, they don't want the economies. They hate recessions. We never have a recession for more than a few months. So if the stag part of stagflation gets worse, they will make sure that things get back on track. And I think that's why, yeah, silver will do well. Plus, you were talking about the structural deficits that silver, 6 years, I think, of deficits. Uh, and there's not that many new like pure play silver mines coming for production. It takes years to develop, explore and develop the mines. So yeah, the setup is really good for silver. And like you said, the gold silver ratio is still, up until a couple of weeks ago, it was coming off. We've come back up a little bit. I don't know if it's around 60 or so, but there's potential for it to go a lot lower. It was at 30 in 2011, but as you know, probably historically, the last, well, 2,000 years, the average is more like in the teens than where we are.
Let's get into some price outlooks, and we'll start off with gold. Where do you see gold ending this year, and where do you see gold in 2 years' time, and then in 5 years' time?
Yeah, I mean, I was thinking earlier today, I think, and it might sound not very specific.
Stagflation hurts savers fastest when policymakers refuse to call it by name. As Mario Innecco points out here, silver's industrial role and multi-year supply tightness matter because deficits can persist while governments still try to smooth recession optics with liquidity support. The harder question is whether central banks fight inflation publicly while quietly defending growth behind the scenes. If that tension deepens, traditional safe allocations may underperform hard assets. Next, Mario Innecco reveals why the gold-silver ratio may still expose how mispriced scarcity really is.
But I remember after the 2024 election, gold had gone up to 2,800 and then it dropped to 2,500 after the result. And a lot of people were worried. And here we are now at 4,500 almost, I think, near there. So almost $2,000 higher. But if I had to pick a number, I would say we could go as high as 7,000 by the end of this year. I wouldn't be surprised. And in 2 years' time, we could be even at 8,000-10,000. I wouldn't be surprised.
7,000 gold by the end of this year. What takes us there? I mean, if we're not, what's the narrative? What drives us there? If we're Fed's not cutting rates, which it may not. Now the latest data is actually expecting, well, there's about 40% chance, according to the CME Market Fed Watch tool, that they'll actually hike again. So what propels gold to 7,000 by the end of 2026?
Well, I look at that on a technical basis. I look at technical analysis as well. So I think it could be fairly easy to get there if we go through the old high at 5,600. And if you look at the bullion banks, even though I think the bullion banks have been following them since 2002, and I always found that their forecasts were very conservative and they always had to revise it higher, with the exception of Goldman Sachs, who see gold at 5,400 at the end of the year. Most of them see it around 6 and even higher than 6,000.
Markets can absorb rate fear longer than most investors can absorb narrative confusion. Mario Innecco notes a sharp recovery from post-election weakness, but the deeper issue is whether technical breakout levels matter because institutions repeatedly revise higher only after price already forces them to. That pattern says forecasts often trail positioning, not lead it. Investors relying only on bank targets may arrive after the largest wealth transfer phase. Next, Mario Innecco unravels why bullish revisions may reveal institutional caution, not confidence.
So that's why I think 7,000 wouldn't be a stretch. But in terms of what might drive it there, it's difficult to say because a lot of people thought at the beginning of this war against Iran that gold would go to the moon because oil would go higher and it's a safe haven. And it hasn't really done that, even though we're still up on the year. So, yeah, all those reasons you said that they might hike rates might not be, let's say, positive for gold, but I think a lot of times you get something like that, and it's like it's already priced in because people are looking at it already. So yeah, mostly technical, but fundamental. Yeah, it's difficult to say, Michelle, because right now everything is so uncertain uh, between the U.S. and Iran and this conflict that if there is a resolution very soon, yeah, it might help things. It might drive oil lower, and it might make the central banks hold off from raising rates. I mean, I saw some statistics in Europe today. The purchasing managers index, service sector, they all dropped well below 50, even though the US one's still holding up. But I think it's only a matter of time. So, yeah, if we get some kind of resolution to the Iran war, and then yeah, we could see things calm down, the central banker, and the economy slows down, then they might actually have a reason not to raise rates. And if anything, I follow M2 or money supply, and for all the major countries, it's making record highs. So they are kind of inflating. They're talking about higher rates, but at the same time, they're pumping the liquidity into the system.
Safe haven assets don't always surge when fear rises, and that contradiction is where most narratives break. According to Mario Innecco, rising liquidity and weakening economic signals may matter more than war headlines because markets often price geopolitical panic faster than monetary expansion. The sharper question is why central banks discuss restraint, while broad liquidity keeps swelling underneath. For wealth preservation, the gap can quietly erode purchasing power before markets fully reprice.